Good evening, and thank you everybody for coming along to listen to this presentation. I hope some of you have had a chance to try some of the fantastic cupcakes which my colleague Sunny organised for the 21st birthday, sadly not my 21st birthday, but the 21st birthday of Schroder UK Midcap PLC, because Schroders took over the trust in 2003, and it was actually May 2003. So I said to Sunny, can you do something creative? And he absolutely knocked it out of the park, so thank you. What can I say about midcaps? One thing I did want to say actually on the subject of yellow cake is come on into the main list. The water's warm, very warm at the moment. The reason for the green shirt is obviously we keep on getting these very interesting green days. We had one day last week where 4 midcap stocks were up by 10% plus. We had Keller, we had Britvic, we had Hunting. We're getting some really big moves now. I think interest is really starting to gather. I think probably what I want to explain today is why we like UK midcaps, why we like them now, and how the trust is doing at selecting the best midcaps. So the aim of the trust is to select the 50 best midcaps, so out of the FTSE 250 excluding investment trusts, and actually there are only about, can anybody guess how many stocks are in the mid 250 excluding investment trusts? Any guesses?
170?
Yeah?
170?
Yeah, just under, yeah, and the line keeps going down. So we just got to pick the best 50, and how hard could that be? So we'll see. So just showing you the team there, slightly blonder now than I was when I started at Schroders 8 years ago. Some of you might know Andy Brough, very well-established fund manager, small and mid-cap, and that it's great to get that sort of, we see the ideas come through the small cap, and so we know them quite well by the time they reach coming to maturity, or their teenage years maybe, in mid-cap. And my colleague James Goodman as well. So we find 3 works very well as a sort of team resource. Aim of the fund, wanting to beat the mid 250 index. It is actually the best performing UK investment trust since equity investment trust since we became manager in 2003. I can't take all the credit for that, as I say, at Schroders for 8 years. And I'll talk a bit more about dividends later on. Some key numbers, you can flick through that at your leisure afterwards. Some outperformance figures. Again, this is all sort of compliance related. We need to show performance in this way for these sorts of presentations. But you're interested in why do you want to invest in UK mid-cap stocks, and why do we like them so much? Well, we actually call it the Heineken Index because it gets refreshed like no other. You get the promotions to the FTSE 100, you get the demotions to the small cap, you get that quarterly. And you see some really big moves. I mean, today it began to look like Hargreaves Lansdowne, for example, is being promoted back into the FTSE 100, and you really saw it start to move. You get those sort of fallen angels, and we're there to meet them, open arms. We'll buy them when they fall out of the FTSE 100, and then we sell them when they go back in. An example of when we've done that is Royal Mail, or the company formerly known as Royal Mail, now known as IDS. Fell out of the FTSE 100, we bought it, it went back in. We sell them when they go back into the FTSE 100, we look for the next opportunity. Then it fell out again, we sold it again. Looking for the hat trick on that one potentially, but we'll see about that because it's obviously in a bid situation now as well. And I'll talk a bit more about that too because that's really hotting up now. We talk about a wealth of companies operating in high growth niches, and we reckon there are about 89 different separate niches you can invest in mid 250, from sort of animal health all the way to specialist retailers and the likes of, I'll talk a bit about it later, Games Workshop, which is unparalleled. That's one of the little figurines, if anybody's familiar with Warhammer. And so, very unusual, some real specialist growth stories within this index. Very well covered dividend payouts, which enable us to pay good dividends out of the trust itself as well. I talked about the fact that we sell when companies go into the FTSE 100. And you get a very different sector exposure. I'm sure you're all very experienced investors. You understand that you're very focused on, say, sterling weakness if you're investing in the FTSE 100, certain sectors, energy, banks, the big pharmas. It's very particular engines of mining as well. And this is so different with all these different micro themes that can really grow. And then about half the revenues are ex-UK, so 50% of revenues being non-UK, so you can flex in and out as well. So you don't have to, it doesn't have to be the domestic stocks. You can really focus away from that as well, and that was the right thing to do, for example, after the Brexit vote, having plenty of those stocks earning for non-UK currency, so you can flex around that as well. So what has this given us? Well, actually, the mid 250 has outperformed major developed market indices over the last 25 years. Now, that's in local currency, but actually in dollars as well. If you repeat this exercise, it's just meeting the S&P 500. So you've got the mid 250 there, the green line, obviously green is a theme, followed by the S&P, and then you've got some FTSE 100 thing there at the bottom, and then you've got Euro stocks. So you really see that this is a hard index to beat, actually. So maybe not as easy as I described the job to begin with. So why do we invest in mid 250? We want to invest in these FTSE 100 companies of the future, wave them off when they get into the FTSE 100 and look for the next opportunity. So I just thought I'd give you an idea of some of the companies that we hold in the portfolio. And I mentioned Games Workshop, and I have my bit of merchandise here. Anybody guess what one of these little figurines might set you back? Anybody been stung for one of these recently? Wait. You're in the realms, yeah. And the tiny little pots of paint, which I think have a margin of 88%. Some of them are 16 quid for a special eyeball colour. I mean, it's really out there. I think the Guardian called it heroin for middle class nerds. I didn't say that. That was a Guardian headline. But that is really, it's the addictive nature of it, but it's also mindfulness as well. And anyone who's been to their head office in Nottingham can really see how engrossing it is. And I would be happy to see my two boys play, but I haven't got them involved yet. Man Group, obviously a competitor to Schroder's, but using AI and asset management, using billions of pieces of data and analysing those, and doing it for the last 10 years. And actually, when I checked my notes from when I saw them, I saw that actually they did talk about AI way before anyone else was. So, really groundbreaking companies. Telecom Plus, which is cutting prices of utilities for households around the country, and only 3% market share, but stands up well against the big six and has a price advantage because it negotiated a long-term energy contract with npower many years ago, and so then offers other utilities as well. And then people do it's like Avon lady type selling as well. So they sell to their neighbours and friends, and they become agents for Telecom Plus. So it's a bit of a religion as well, being an agent for Telecom Plus. And it's Utility Warehouse. It's the Purple Pig, you might know the brand. And then Spectrus as well, analysing nanoparticles, in days, which would normally take a year. So sort of shrinking time for large corporates. So it's just some examples. So I talked about M&A because I think that's the big theme of the moment, and I'm sure that you'll want to talk a bit more about that. You might have seen the headline in the FT last week. UK, takes the crown for biggest market for M&A so far year to date. So you've got $80 billion worth of deals. 4 months in. 4 months can be a very long time in the world of capital markets. At this rate, no capital markets left in 10 years' time, something like that, if you assume certain bid premia. To give you some stats, 52% was the average bid premium last year, and I think that for the UK, and I think that shows you that's crystallizing that valuation gap. And I'm not saying that that everything went for the price it could have gone for, but to give you an idea, the usual premium is more like 30 to 40%. Now, year to date, we're looking about a 44% premium, but we had a bid for a stock in the portfolio today, and that was at 70% plus premium, but still more than 50% below its all-time high, and that was XP Power, which the eagle-eyed among you will know is a small cap stock actually, but we do hold on to stocks if they fall out of mid 250. So what's this telling you? So that blue line is telling you, that navy blue line, that is the percentage of the index that gets acquired every year, and you can see, if you're in small or mid, you're much more likely to get that performance premium from holding stocks that get bid for. Equally very painful if they get bid for and you don't own them. So, it's an interesting one to try and call. But obviously, that's not why you buy a stock. It's got to have good structural reasons to hold it in the first place. So it's the biggest year since 2018 for UK bids, and of course that was when we had a FTSE company. It's a significant number of FTSE companies bid for. So, and that's just telling you that normally you get maybe 6%-ish of mid-caps bought, of the index bought per annum. I talked about dividends earlier. So the dividend on this trust is a 10-bagger. We all love 10-baggers. So we start with 2p dividend back in 2004. And then, so the trust is 1 year old and starting to walk. And then we move all the way to 2023 and we've got 20.5p dividend, and that's 13% per annum, so beating even some of last year's more eye-popping inflation figures. It was never a trust that was meant to be generating lots of income, but the fact is that we invest in companies with very strong balance sheets, and this is sort of a side product of the strategy. And many of the companies can pay dividends and invest heavily in their own capex. I'm thinking of companies like Cranswick here as well, sausages and bacon and McCrispy chicken burgers, and that's a mid-cap, and they can do this and still pay out dividends and actually buy back shares as well, which is enhancing the yield on this asset class too. And on the top right there, I'm just showing you, people think obviously houses are a great hedge against inflation, but actually on the house prices, you've only doubled your money in that time, whereas it'd be 10 times better than that if you had just stuck with UK mid-caps. This has been a very popular theme. So we all talked about 10 baggers, and I was asked to present on 30 years of mid-250 investing by the LSE about a year ago now, and we decided we'd look at 30 baggers, so stocks that were made you 30 times your money over 30 years. And what we saw actually was that if you just did it purely without being just throwing a dart at a dartboard, you were more likely to find a 30 bagger in the UK market than you were in the US. And this caused a lot of consternation among my US colleagues, who then tried to prove me wrong and then couldn't. So that was quite good. So it's just, you get 59 of them in the UK, and they have to be investable. They have to be a certain size. So we set it at 150 million market cap. And then you get 5.4% of the total investable universe in the UK being a 30 bagger versus 4.2% in the US. So I think this is kind of helping to explain, so why was the mid 250 has it been such a strong investment proposition? And then you'll then say to me, so Jean, what are the names? Well, here are some. They've all been either current or previous parts of this fund, of this trust, and 1, 2, 3, 4, 5 of them are still in the trust. One's been acquired, and then you'll have to guess which the ones that aren't. Well, some of them have gone into the FTSE 100, so as you'd expect, they've been sold. So I think that's again, I can't take the credit for having owned all of them, but I think you can see it's a very rich sort of a variety of companies that you can invest in as well. And I mentioned Cranswick already. But 4imprint is likely to have done, say, the branding for some conferences, and that's based 98% in the US. And it does merchandising, names of companies on golf hats and fleeces and so on, and pens for conferences, but always, in the time you need them. So timing is of the essence. So moving on from that, not wanting to go on too long, I talked about buybacks, just telling you're all aware UK buybacks are really a huge theme now, and really keeping up with the US, and that is also helping to improve your returns as investors in the UK market. And this is just a bit more analysis. I won't dwell on it because I'm running out of time. Of the amount of mid 250 and FTSE 250 companies buying back shares. A significant number is the message, and I have some examples in my head. I was just looking at Grafton this evening. That's bought back 18% of its own market cap in the last 2 years. So some really punchy numbers out there. Paragon's another one, another mid-cap. It's a buy-to-let specialist lender. Just on valuation, why now, Jean? Why are you excited now? If you're not really excited about those dividends and buybacks and M&A, how about we look at valuation? So FTSE 250 clearly standing out at the bottom of the range there, 11.2 times as its current median forward PE. And then you'll say to me, but look at this shocking state of the economy. We won't debate that right now, but you can see it's the economists within Schroder's that gave me this lovely chart last week. You can see it inflecting on the right-hand side there for the UK. So, you could also say, well, we've had a terrible 2 years, but the point is the direction of travel is in the right direction and is diverging from where other economies are going at the moment. And we'll find out whether we've reached that magic number tomorrow with inflation. So I think it's going to be the highlight of my day, I'm sure. Because the mid-250 is extremely sensitive to inflation, which we know by back testing. This is just looking at SMID more generally, and you can see UK still stands out, because you might say to me, well, Asian small caps are attractive, or you might say world small caps are attractive, but I'm just being very transparent with you here. So the box there showing UK relative to the rest of the world, small and mid. I did it for mid, but it was the analysis wasn't robust enough, so I've gone with SMID here. So, are you too late for UK equities? The good news is, still nobody likes us, but we don't care. It was one of my football-loving colleagues had that idea. You can still see we're third from the bottom, although the allocation is rising. So fund managers, about 400 fund managers and asset allocators answer this questionnaire put together by Bank of America every month, and you are getting the allocation rising. But let's not get too excited. I mean, something happened around here. And we're seeing, money piling out, and you've seen all the headlines for that. I won't go into our, because I've run out of time, I won't go into the way we invest unless you'd like that to ask me that in our Q&A, but it is in there, how we buy, how we sell. And then I have two examples of stocks, two categories that we buy, unique and flex stocks. And I just leave you with sort of the key highlights from the last year. And yeah. I'll stick with that for now.
Thank you very much indeed. That was terrific. I really enjoyed it. Thank you.